This is the weighted average cost of capital, or WACC, dictating how corporate valuation models price risk. These models rely on two pillars: a stable risk-free rate and mean reverting energy inputs. In March 2026, both historical assumptions failed simultaneously. The physical catalyst began with the Iran-Israel conflict. The Strait of Hormuz is effectively closed, trapping oil tankers and severing global oil flows. The structural catalyst emerged from Washington. The US Treasury's fiscal year 2025 consolidated financial statements reveal a federal government that is now technically insolvent. We are going to map how these overlapping exogenous and sovereign crises force a probabilistic recalibration of corporate debt modeling. We will also identify which business sectors are structurally impaired and which are optimized for this environment. Utilizing static historical baseline models is now a liability. To avoid mispricing systemic risk, capital allocators must immediately adopt dynamic valuation overlays. Look at the physical reality of the Middle Eastern energy disruption. Flows through the Strait of Hormuz have collapsed from approximately 20 million barrels per day to a trickle. Iraq formally declared force majeure, a legal clause suspending contractual obligations due to extreme, unforeseeable events on its foreign-operated oil fields. This removes 73% of the Basra Oil Company's production, erasing roughly 2.4 million barrels per day from the global market. The degradation extends to liquefied natural gas. Qatar Energy issued its own force majeure declaration, with its chief executive confirming that 17% of their LNG capacity has been physically destroyed for the next 3 to 5 years. As the energy crisis deepens, traditional safe haven assets are behaving paradoxically. Gold prices collapsed 9.6% in a single week, its worst performance since September 2011. This combination of physical supply destruction and safe haven asset liquidation is a significant red flag. It points to forced institutional margin calls across equity books. The market is under acute liquidity stress. The commodity inflation is merely the surface-level symptom. This is a Monte Carlo probability tree, a computational algorithm that relies on repeated random sampling to model the probability of different outcomes. We use it here to translate volatile geopolitical developments into actionable financial price targets. The direct Iranian missile strike on Israel's Dimona nuclear facility effectively eliminates a rapid resolution. Consequently, the rapid de-escalation scenario drops its probability weight to 12%. The 48-hour U.S. ultimatum targeting Iranian power plants, combined with a marine buildup near the strait, shifts the distribution. The likelihood of a prolonged conflict rises to 43%, and a full strait closure increases to 24%. Simultaneously, contradicting diplomatic signals, a 15-point ceasefire plan transmitted via Pakistan against flat Iranian denials, create highly volatile, underpriced optionality. The diplomatic off-ramp scenario holds a fragile 13% probability. The output of this distribution invalidates discounted cash flow models, which estimate investment value based on expected future cash flows, using a $60 structural glut thesis. Analysts must now anchor their models on a probability-weighted price of $95 to $105 per barrel for the next 90-day horizon. These sustained prices trigger specific mathematical adjustments. The mild stagflation stress test automatically activates when oil remains persistently above $85 per barrel for more than 60 days. Capital allocators must apply a mandatory 15 to 25% when-new growth haircut in cash flow models for any acquisition target with high energy intensity. Cross-border supply chains face a compounding double impairment. Elevated input costs are colliding with legal uncertainty from 900 lawsuits and Section 301 universal tariff investigations, a statute allowing the U.S. government to impose trade sanctions on foreign countries. Relying on pre-February 2026 cash flow projections for manufacturing or logistics targets now constitutes a material earnings quality failure. Those outdated models completely ignore these compounding cost vectors. While Middle Eastern supply is destroyed, a significant localized fiscal stimulus is occurring in Europe, providing a powerful counter-trend variable in the global economy. The European Union launched the €150 billion Security Action for Europe, or SAFE Fund. Alongside this, they activated fiscal escape clauses for 17 member states, allowing them to bypass normal deficit limits. This pivot authorizes a wide scale of national commitments. Germany is pushing its defense spending to 3.5% of gross domestic product, and Poland has committed a record $55 billion budget. This represents a Keynesian structural repricing event for European aerospace, defense, and critical minerals targets. It creates a guaranteed 4 to 5 year order book that partially offsets broader regional stagflation risks. The most structurally significant macroeconomic outlier of the cycle comes directly from the publication of the US Treasury's fiscal year 2025 consolidated financial statements. This balance sheet visualization presents the stark accounting reality published by the government itself: $6.06 trillion in total assets, against $47.78 trillion in total liabilities. This results in a negative $41.72 trillion net position. The velocity of this deficit is accelerating. The fiscal year 2026 projection sits at $1.9 trillion, and annual debt servicing costs have crossed the $1.22 trillion threshold. For U.S. domiciled acquisition targets, the impending depletion of the Highway and Social Security trust funds will force mandatory entitlement reform, directly threatening domestic consumer revenues. These published figures confirm technical insolvency. Markets will inevitably demand a fiscal risk premium on U.S. Treasuries, shattering the foundational risk-free rate assumption of modern finance. To finance deficits, the U.S. government absorbs massive capital from public debt markets. As private capital drains, leveraged corporate debt financing costs rise sharply. Analysts must now apply a mandatory U.S. fiscal risk overlay to the discount rates of all long-duration cash flow models. Modelers must price a 15 to 20% probability that the 10-year Treasury yield rises 100 to 150 basis points within the next 24 months. Heavily leveraged buyouts relying on cheap U.S. dollar debt are structurally unviable in this new rate regime. Equity-heavy or defensively capitalized deals command a high premium. The 5 M&A archetypes matrix identifies which corporate strategies are impaired or optimized. Standard scale acquisitions are severely impaired. Cross-border supply chains face massive synergy risk due to Section 301 tariffs and Gulf logistics failures. Geographic expansion into Asian markets is highly dangerous right now. The Qatar LNG suspension is driving disproportionate industrial demand destruction across Asia. Contrast these liabilities with the innovation archetype. We are currently tracking a $720 billion artificial intelligence sovereign infrastructure supercycle. This sovereign AI infrastructure cycle operates decoupled from public fiscal rot. It is funded almost entirely by highly liquid private technology hyperscalers. Capital is aggressively fleeing traditional scale and consumer markets. Instead, it seeks yield in sovereign-aligned, physically localized infrastructure, like European defense and AI data centers. The macroeconomic reality is clear. Pre-2026 historical averages are dead, and relying on them is financial negligence. Every valuation requires pre-mandatory adjustments: a WACC uplift for sovereign risk, revenue haircuts for stagflation, and probability-weighted $95 oil inputs. In a polycrisis of regional war and federal insolvency, capital allocation requires epistemic humility. You must apply dynamic overlays to survive the baseline model's collapse.